is it, again, I want to ask you, the merger coming undone or something more? Like, is it just a company-specific thing that's a problem, or might it be the canary or owl in the coal mine? Like, is it something more in terms of what's going on in the private credit world?
Look, blue owls are supposed to be fictional characters in the real world, and it's now up to the blue owl management to prove that their marks are not illusory. In a credit market where you're dealing with private loans, the investors, your investors, are reliant on what you believe those loans are worth. Unfortunately for Blue Owl, many of their investors in their publicly traded BDCs don't quite believe the book value, and that's why it's trading at a big discount to book value. If you want to blame negative articles, that does sound a touch defensive and it's not going to really help the cause. And there are a lot of Wall Street veterans who are pointing in this direction and talking about trouble. But I would like to take a step back and say, you know, when you ask about whether this is a canary in the coal mine, we haven't seen some crazy implosion. When you're investing in 100 companies, there will be some defaults along the way. Right. The question is, can you keep it below what your peers are experiencing, and is it below your historical averages? So that tells you where you are in the credit cycle. And on those metrics, Blue Owl and the rest of their peers are seemingly doing just fine. But the mind goes back to the kerfuffle last month when Jamie Dimon got on the earnings call and gave what sounded like sage advice about the credit cycle and said, you know, when there is a problem somewhere, you can expect a few other problems to crop up, a few other cockroaches. For some reason, a lot of players in the private credit market took it as a direct insult hurled in their direction and got worked up about it. Prominent in that was Mark Lipschultz of Blue Owl, who really took a real swing at Jamie Dimon. A month later, you kind of feel like saying, if you come at the king, better not miss.
Well, before, I want to bring in Davide, but Jamie Dimon, how many times have we had conversations with you? We all wait to see what he has to say about any situation. He doesn't, or does he, just drop something to stir the pot? Does he do that?
Let me tackle this carefully. I think the fact that Jamie Dimon has been the CEO of JP Morgan, the largest bank in the United States with a $4.6 trillion balance sheet for 20 years now, right? Like it makes you think that he's coming from a vantage point that is unparalleled, to be honest. And he's got the experience and the position and the pedigree to speak his mind, and thankfully he does. In this case, and if you look back over the years, some of the things that Jamie has said, whether it's about work from home or a myriad number of topics, can veer towards the extreme. But what he said here seemed fairly innocuous. All he said was, there's never just one cockroach. There will be other troubles that crop up. He didn't necessarily say the others will be in deep distress. Why did the private credit industry take it so personally?
So Davide Scigliuzzo, come on in here, because you cover private capital for Bloomberg News. The focus that we've had this week has certainly been on Blue Owl, not just investor reaction, but also the press that we've seen around the company. Is this something you're seeing in your world outside of Blue Owl right now too?
Yeah, and I would say one thing to Jamie Dimon's comments, like, he wasn't wrong, because we have seen more of these situations, and across the industry. By the way, we've seen them on the bank side too. So I think there is a broader issue kind of in credit markets where people are questioning like some of the underwriting standards and red flags that may have been ignored in the past, and that cuts both ways. I think what Blue Owl really put on the map is an issue that all of these firms are kind of wrestling with, which is how do you sell this asset class to retail investors, and what is the right format to do that? You can, historically, they've done permanent vehicles, like very long dated stuff that it's great for institutions. You lock up your money for 7 years and it works well for them. But if you're making a push into individual investors, you have to provide some kind of liquidity. And what is emerging with this failed merger of Blue Owl is that liquidity is an in-between between daily liquidity and 7-year liquidity, and it doesn't kind of work as intended sometimes.
Well, how big of an issue is that for private credit overall if they don't have the market that includes retail investors?
I mean, I would say it's a big issue because a lot of funds are being set up in a similar way, where they provide quarterly redemptions subject to a cap. And you can either come out at NAV, which is basically the value of the assets in the fund that the manager assigns to them, Or if it's in a public structure, you come out at the price that the market assigns to it. And the market right now is believing that most BDCs are 20, 30% below their asset value.
But here's the thing. There was nothing crazy or revolutionary or wacky about Owl Rock or Blue Owl wanting to merge a private fund with a publicly listed BDC. It has been done in the past. The problem and the challenge was it was being considered, or at least it was presented to the market at a time when the amount of redemptions in that private fund were climbing. And if it climbs above a certain mark, Blue Owl might very well gate redemptions, and you never want to be in a position where you tell your investors you're not allowed to get your money back. They had been honoring all their redemption requests so far, but if you ever had to get to the position of gating redemptions, or basically saying, right now we will not allow you to pull all the money that you want to pull, that spurs panic. That results in more people wanting to run away from your vehicle. So instead, when they talk about wanting to merge it with this public vehicle, which is trading at a 20% discount to book value, which means once you're in there and then you want to get out, you have a 20% loss on day one, it starts to feel a bit icky. And that's what really resulted in this market reaction that makes Blue Owl, or at least pushes Blue Owl into this defensive corner.
But all of this makes me feel like, okay, if Blue Owl is supposed to be the poster child, like if we're talking icky or redemptions or gating those redemptions, that to me, if you're talking about the poster child for private credit, then it makes me wait, like, okay, if they're supposed to be up here and they're maybe potentially having issues, what else is out there? Because not everybody's in the same situation.
And that
in other
goes
words,
back,
they're in weaker situations.
And that goes back to the broader concern about the industry. It's not just Blue Owl. I think Blue Owl is in the spotlight because they tried to do this at what some people, many people probably now would argue was terrible timing. But it is an issue that everyone in the industry has to kind of deal with.